Good morning. Today is Monday, June 5th. Thanks for joining us. We do have a little bit of a different format this week, and the format's going to be a little bit different because we're going to be doing a special series, taking advantage of a slower week and doing a special series on the U.S. budget situation. Over the next few days, our schedule is going to look as follows. So today, we'll hit a couple news items, and then we'll transition to the bulk of the podcast this morning, which will include a brief history of the U.S. debt situation, the debt situations in general, interest rates, and inflation. And this goes back to the year 1300. So we really tried to take a very long-term perspective on this to try to get some context for where we are. Tomorrow, we will look at, it's called balance. So we're going to take a look at the U.S. federal budget. We're going to take a look at the balance sheet, and we're going to take a look at who holds the U.S. debt that's outstanding. And if anyone has an issue with being able to see the screen, please, you can put this in the chat. We haven't done it this format for a while. Wednesday, we're going to talk about solutions of ways to remedy the situation. Of course, that comes with a big asterisk, namely, you got to get that through politics, and some of our solutions people aren't even talking about. And then Thursday, we're going to be talking about the reserve currency status of the U.S. dollar. What is a reserve currency, and what does it mean? And what would happen if, by some chance, the U.S. were to lose that status as the reserve currency? So with that, we'll just touch on a couple key stories today. The first is OPEC Plus did cut some oil, but all of that's coming from Saudi Arabia. They're going to cut 1 million barrels per day. It was a bit of a contentious meeting. A lot of the African countries didn't want to play ball. There were some reports over the weekend that representatives from the country of Angola walked out of the meeting. But Saudi Arabia really wants that oil price higher, and it is a little bit higher today. I think it remains to be seen what impact that will have. My guess is that this is really a demand-driven commodity right now, and if demand continues to deteriorate like we're seeing in China, that will mean lower oil prices will persist. The second big story of the day is the Worldwide Developers Conference. Apple's kicking it off with a keynote address today at 1 p.m. Eastern Time, 10 a.m. Pacific Time, and they're going to be unveiling a new mixed reality headset. It's going to be extremely expensive, I think probably north of $3,000. And they're also going to be talking about their new iOS, which is going to be iOS 17. So that'll be probably rolled out in the month of September to everyone with iPhones, iPads, etc. And it's gonna basically have all the, they're going to talk about the new features that they're going to add. So with that, we're going to jump in, and Andrew's joining me today as well. So he's going to be chiming in with some perspectives on this. Again, today we're going to be talking about is the first look at first in our four-part series. It's going to be a look back, the history of debt, inflation, and interest rates. I think it's important to note here that real rates have trended down for nearly a millennia. So again, this goes back to the year 1310. They've been less than 5% since really the 1700s. Now, what a real interest rate is, you take your inflation. So let's say inflation is 2%. And then you add a real interest rate to that. And as you can see here, typically that is often, another 2 to 3%. So that gets you to that 4 to 5% or even 6% range over a longer period of time for nominal rates. And you can see, this was taken from a paper from Rutgers, but real interest rates have trended down, and part of that makes sense because the issuers of a lot of these pieces of paper, a lot of this debt, have improved in credit worthiness over time, and part of that, frankly, is because these countries can print their own money and also print their way out of debt to the extent that they need. In nominal rate, so this is the rate that we see, 4 to 5% is actually more than norm. And this is not, when we talk about low rates, I think that we look at low rates based on what we could see since the 70s and 80s. But the problem is, on a longer time historical context, the 1970s and 1980s were really the anomaly. They weren't the norm in terms of interest rates. If you go back all the way to the 1700s, you're talking about interest rates in the 4 to 5%. Now, of course, this has ticked up more recently. We're back into that 5% range now. But again, that is more normal than abnormal. Andrew, I'm curious if you have any perspective on this.
Yeah, I think that's the big takeaway. I mean, even this morning we were having a conversation with some clients and some folks we know, and it's so easy to sit here and think about the printed interest rate as opposed to the actual interest rate. And I think, for better or worse, there's a lot of people here that say, "Oh, well, the first home I bought had an interest rate of 12%, or my parents bought their first home with an interest rate of 13%." There's a lot of that, but so much of this requires historical precedent and understanding. And I think even as you think of the real rates declining, a lot of this actually has to do with the community's ability to actually underwrite risk. I mean, if you think back to, making a loan to Edward III back in, the 1300s, there was so much uncertainty there. I mean, we would price a deal if we were loaning money to a brand new business with a first-time entrepreneur. We would price that at a much higher interest rate than somebody that has a proven track record in a specific field and is just doing more of the same. And as the financial system has evolved and has become more sophisticated, it's also easier to handicap the types of risk. Any type of project probably has some kind of historical precedent for which we can say, okay, well, we know historically how consistent this municipality has been at paying off the cost of building a new bridge. We know historically how often Apple has repaid its debt. We know historically this type of development project typically looks this way in 3 to 5 years. And so we also just know a lot more, and that gives investors a bit more confidence and de-risks the situation.
Yeah, definitely agree with that. And for the last few hundred years, as this financial system has developed, we've really been able to continue to see that trend lower. Moving on to inflation, historically, inflation has been pretty low. Since the early 1300s, the GDP weighted annual average of inflation has been 1.6%. So GDP weighted, what does that mean? That basically means that it's weighted to the largest economies. So you're not going to see South Africa represented significantly here, or Zimbabwe, where we know there have been periods of, triple digit inflation, even quadruple digit inflation at times. These are going to be weighted to the largest economies. And again, what you can see is you typically throughout history have had relatively low inflation. Now, some may make the argument that this is because we weren't relying too much on fiat money, but there were periods of time, for example, in the pre-revolutionary period, or even shortly post that, when there wasn't a consistent currency in the United States, and that definitely plays a role too. So over time, inflation has been relatively low, and the more recent periods are more anomalies in terms of global inflation. And you can see that perhaps even better here when you look at, it breaks out the inflation rate, the nominal interest rate, and the real rate. So again, the real rate is simply the difference between the nominal rate and inflation. Today, as we all know, the nominal rate on short-term debt is about 5.5%, 5 to 5.5%. Inflation rate is probably around 4.5 to 5%. So the real rate would be about 1% today. And this is relatively consistent historically. I think over time, as we look into what our near-term future looks like, I think you'd like to see inflation probably go back to that 2% range. that we've seen over the long period of history. And nominal rates maybe decline a little bit and give you a real rate maybe in the 2%. So maybe we have 2% inflation, 2% real interest rate, and 2% nominal rate. But again, over the long period of a long history, real rates have declined somewhat. And again, part of that may be due to the fact that the U.S. government has control of its currency and can actually, it has a lot of tax authority. It has a lot of power to get its way out of debt, and I think that should be encouraging to borrowers, to lenders today, versus discouraging.
Yeah, and I think then one thing that stands out on that to me is, when you think about the last decade or so, which really is, nearly half of the 2000s, you think of the low interest rate environment, and I think I would have expected this chart to have a real rate, which you can see here is 1.3. I would have expected that real rate to kind of stick out like a sore thumb in terms of being so suppressed. But the reality is, it's very much on trend, especially going back to, call it the 1500s, as you see just kind of these stair steps down.
Yeah, I'd agree. And I think the other piece of that is negative interest rates. I think that everyone talks about how it's crazy that we had negative interest rates. It's actually happened before, on a few occasions. It happened in the early 1900s. It happened at the turn of the 19th century, between late 1700s, early 1800s, during the Napoleonic Wars. And I think that those are, there is nothing new under the sun when it comes to economics and finance. Having said that, we do acknowledge that more economies are playing with negative real rates than they have historically. The axis on the left-hand side shows you the percentage of developed market economies that have negative long-term real interest rates. And as you can see, I mean, we're definitely trending higher over time as economies maybe play a little bit closer to the line in terms of taking those interest rates negative. But again, in a historical context, 25% of GDP versus 19% of GDP, that doesn't really govern things in a that's not really showing dramatic change. The other piece here is that rates don't often exceed inflation by much, and so and that spread has actually tightened over time. So I think a big piece here, and as we look at the debt, so we've talked about interest rates, we've talked a little bit about inflation. Well, let's look at the debt situation, because I think that's a topic that's on everyone's mind right now, especially given the recent increase in the debt ceiling. So Great Britain, after the Glorious Revolution in 1688, which was when William of Orange replaced James II as the monarch in Great Britain, UK GDP went from about UK debt to GDP, there's a typo there, went from 5% to more than 200%. For context, right now, the US debt to GDP ratio is 130%. But one of the reasons they were able to do that was because all of a sudden, Great Britain went from not being a credible borrower to being an extremely credible borrower. No one wanted to lend money to Great Britain because of its monarchy and its inability to pay its debts. And then by the 1800s, everyone wanted to lend money to Britain. And so they took on lots and lots and lots of debt. They also took on lots of debt to fight Napoleon during the early 1800s. And so the chart on this, the right-hand chart here, shows that debt to GDP ratio. And again, you can see in the early 1800s, that swelled to over 200% debt to GDP. But if you look at the subsequent 35 years, you actually saw declines there. And that was because the economy began to accelerate. And this is really going to lead a lot into what we're going to be talking about on Wednesday when we talk about potential solutions. And really, the key element here is that in order to deal with high debt to GDP ratios and take those down is, yes, you can reduce the debt. potentially. But the best way to do it is to increase the growth. So how did they do it in Great Britain? Well, there's a thing called the Industrial Revolution. And essentially what you see here, look at the Harley chart here on the bottom left. You can see that the Y is the economic output, the GDP growth of Great Britain during certain time periods. So between 1760 and 1800, that was just 1%. But they managed to increase that to 2.5% by increasing the productivity of the economy and also increasing the amount of capital employed. I think if you were an optimist on the United States right now, what you would say is we can really increase the economic growth of the United States by increasing the GDP. How do you do that? Well, you increase the capital employed, you increase the productivity, maybe artificial intelligence helps to do that. You increase the labor. How do you increase labor? Well, you need population growth to do that. You can do that through organic means, or you can do that through immigration. So those are ways to increase that GDP denominator and really get yourself into a little bit more of a mainstream sustainable debt to GDP ratio. And again, it happened in Britain. And potentially it could happen here in the United States. So overall, we'll just kind of conclude this segment. And again, we'll have more on this in the subsequent days. There's nothing new under the sun here. High sovereign debt levels have precedent. Low interest rates have happened before. We really haven't seen that many inflation spikes historically. Inflation really should be more in that 2% or maybe even slightly below that 2% range longer term. And I think the UK, the Great Britain economy example is a really good example that we can look to and say, look, this is not without precedent. And so this kind of sets the stage for what we're going to be talking about over the next few days. With that, I'll hand it over to Andrew if you have any concluding thoughts.
Yeah, I think the leveraging of debt to generate growth is really the theme as we kind of look ahead to what we're going to be talking about more on solutions and things of that nature on Wednesday. And I mean, in some regards, if you've ever purchased a home and then gotten your first real mortgage statement where you actually have to, pay your escrow and your property tax and your interest and your principal and all of that, and said, man, this is a pretty big check to write for the first time now that I'm in this new home. In some regards, you can relate. You've taken on new debt, and a lot of times the solution is simply to increase earning potential and actually grow your income streams. And in some regards, that's what we're going to be kind of pointing to more on Wednesday. I think this is a great time to be having these discussions. We will certainly try to get this up on YouTube even if you have others that want to watch it, and maybe even at the end we could do one big video just for everybody that wants to see it in one fell swoop. But we're excited to be doing this. Ben's done a lot of good work, so definitely stick with us throughout the week and we'll keep going.
Thanks, Andrew. Thanks for joining us. We'll see you tomorrow.